but good luck with that, right? So anywho, what's happening in the markets? Let's see. Oh, futures, that's always good. So generally it's a good day, but I mean, it's no better than it was when they attempted to rally yesterday. We're still below yesterday's highs. And the way yesterday fell apart, there's really, you know, there's not much anything here. It's a neutral day. It's flat into earnings. That's all we are. We're being flat into earnings. We sloped down, we sloped down, we sloped down, and we aren't going anywhere so far. No major bounces, as I noted in the top of the article today. Are earnings going to save us? I don't think so. I don't see why they will. I mean, let's remember the war started, you know, 6-7 weeks ago. So most of the first quarter, not most of the first quarter, I'm sorry, the month of March was shot due to the war, and even part of February. So that's, I mean, you know, how much it impacted American consumers and so on and so forth, who knows? But this is the point of the hedging system, though, because by, you know, oh no, I wanted to get into the other thing first. But, you know, because we have the short-term portfolio and because we have all these hedges, probably too much hedges in the short-term portfolio at the moment. Gonna work. Oh, there's a long-term portfolio. I mean, that's up. That's came back nicely. It's up at 389, so 2445, almost 2.5. And the short-term is 525. So basically 2 million, 3 million, whatever the hell it is. Basically, we're at $3 million, which is as high as we've ever been. The point of the hedges is that when we have a down time like we just did, we had a pullback. Well, here you can look on the hourlies. So, you know, this is pretty significant. So from March 30th until April 13th, we had a pretty sharp pullback in the S&P. It's almost, what is this, 384? It's like 7%, I'm going to say. Calculator. So we're coming down from 4620, 4620, minus 4380, 4380 divided by 4620. Oh, 5.5%. All right, so it's 5%, sorry, not 7%. And meanwhile, that's interesting, right? Because we talk about the 5% rule. Now, really, I would go from 4,600, but from 4,600 times 0.95, whoop, that's wrong, 4600 times 0.95, 4370. So there you go, right there. So 4370 is the actual 5% line, and then you can calculate the bounces. So now you say 4600 minus 4370 is 230 times 0.2 is 46. So call it 50-point bounces off 4370. So you got 4370 plus 50 is 4420. So that's your weak bounce line. And then 50 more points is 4470. That's going to be your strong bounce line. And you can see that's where we topped out last time. So that's how you can calculate the 5% rule. You know, once you identify what range you're in, you can then do this. Then you can do the sub bounces and see where you're supposed to be bouncing inside of this 5% drop. But in other words, the bottom line is until you're over this strong bounce line at 4470, then it's all meaningless. And this is the weak bounce. So if you fail 4420, you got big problems. Now, then you look at the Dow, and now we know that this peak for everybody is basically the strong bounce line. So that peak is there, and the NASDAQ peak is here. and the Russell peak is there. So those are the bounce lines you need to get to in order to consider it something to be considered strong. And that's obviously, you would need to properly calculate each one individually. But once you know one and once you know everybody's following basically the same pattern, you get the idea of like, hey, it's not going to be too far off of that. So what we know now is that this was a strong bounce line. It did fail the first time they tried it, coming back. Now we're at the weak bounce lines. And if we fail the strong again, it's more likely we're going to punch back down. So we'll see what happens. Meanwhile, petroleum status report had very interesting because there was an increase of 9.4 million barrels. Okay, that's not good for the energy industry. And I said earlier, well, was that from the SPR? Well, we did release, see the SPR went from 564 to 560, so about 4 million barrels were taken out of the SPR. So that tells you something. Oh, here's another thing though, look at this. See the other oils? This is where they hide stuff. 380 to 384. So all other oils also went up. Basically just erasing the SPR takedown. And the net, the easiest way to see the net is you went from 708 to 711. So it's 3.5, so 3.5 million barrel total build for the week of product. Even though, look at these exports. Every week they're going up. Now we're exporting 4 million barrels a day. We never were exporting 4 million barrels a day. That did not happen. Now we're exporting 4 million barrels a day. 28 million barrels a week. We are exporting a product. So don't let, when you watch, especially like Fox News, but even CNBC is just as bad, really, where they're pumping oil to the, day and night because that's who sponsors them. They tell you how, the demand and this and that, and all their guests are like, oh, yeah, oil demand is coming back strong, and blah, blah, blah. No, it's not. Our demand a year ago was 19.6. Our demand now is 19.8. We are exporting. A year ago, we only sent out 2.2 million barrels a week. Now we're sending out 3.9. That is 1.7 million, a week, a day. Now we're sending out 1.7 million more barrels. So 1.7 times 7 is 11.9. We're using 11.9 million less barrels per week in the US than we used last year, even though COVID is over. And that's the demand destruction, the relentless demand destruction that we are talking about. And I don't understand why they can't get people, or maybe they just don't invite these people on. It's easy enough, call me up, I'll tell you. I go on TV sometimes, but nobody, this is not a question anybody wants to ask me. But it's not complicated to see. And anybody who's thinking about it would be like, okay, well, if Tesla's selling 1 million electric cars that take 0 petroleum versus 1 million cars, and take my word for it, I'm not going to go through all the math, but basically the average car uses 1,500 gallons a year, because if you get, no, I'm sorry, 1,500 gallons. 15,000 miles divided by, and the average car gets 25 miles a gallon, let's say, 600 gallons. So you're getting 600 gallons a year. So if you take 1 million cars off the road, 1 million gas cars off the road, and replace them with, well, it doesn't matter what electric car, right? Then you need 600 million, and that's times 1 million less barrels divided by 52 is 11. Oh, isn't that funny? It's 11 million barrels a week less. Every time you sell 1 million electric cars, you need 11 million less barrels of oil for the year. I'm sorry, gallons, not barrels. And barrels will be divided by 42. So I'm sorry, that is 250,000. So it's 250,000 less barrels from that. barrels, not gallons. But you get the idea. And that's not the only thing that's going on, though, because the mileage standards for cars are going up and up and up, and they're going to be 50 miles a gallon at the end of the decade. So if we're getting 25 now, and we're going to get 50 on all cars in 10, over the course of the next 8 years or whatever, there's going to be a constant pressure downward slope of demand. It's just bullshit. And the biggest bullshit of all, though, in the world is the fact that we are exporting 4 million barrels a day, 28 million barrels a week. We only use 20 million barrels a day. We're exporting a day and a half of our total oil consumption. It's not our consumption. I mean, seriously, if we start exporting 10 million barrels a day, are you going to say America's oil usage went up 50%? No, it didn't. We're exporting it. That's not up. That's not more demand in the United States. But that's a benchmark, and you see it used over and over again, and it's just bullshit. So realistically, I'm sorry, it already, I didn't know it already did that. So realistically, when we read that report, that's not oil, that's a dollar. Oh, here it is. So realistically, this is wrong. This is a wrong reaction. And basic and oil should be going lower. Now we just had a conversation about that in chat, though, because somebody asked me, like, well, what about oil? I'm like, you can't play it because there's too much other crap going on. But the reality is very clear. The reality is that oil is way too expensive against the fundamentals that we're seeing. The demand is not there to justify this. So it's definitely, I mean, it's a weird situation. And by the way, I object to this concept that we're taking oil out of our strategic petroleum reserve in order to refine it and sell it to other countries. So now our refiners are taking the strategic petroleum reserve that's supposed to protect our country and taking those barrels and refining them and shipping those barrels overseas. This is bullshit. But, even for me explaining it, you can see it's really complicated and there's a lot of moving pieces, and people in Congress have no clue how this works. And the other problem is that you have such a dysfunctional government right now that the only thing a Republican wants to hear is, how can we blame Biden for this? Anything else I would say to them is just blah, 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 blah. They want to see how this is Biden's fault and how they can use that politically against him. They don't give a shit about what's happening. They're like, Biden took out the strategic petroleum reserve. That's bad. We can use that. I'm like, no, that's just like a tiny piece of this whole thing. But he does it because he's misinformed also. This, energy policy in this country is idiotic. Anyway, so I mean, clearly we should have twice as much strategic petroleum reserve. They'll sit there and spend all this money on all this bullshit projects, and meanwhile, you just we have a billion miles of empty land all over the country. And all you got to do is dig a deep hole somewhere in Oklahoma and line it with tanks, like doing a swimming pool, right? You just line it with tanks and you pump oil in there, or you take an old well that used to have oil. You know how many old wells we have that oil used to be in? These are oil wells. Oil came out of them. They are natural containers for oil that are empty. So you take a bunch of those and fill them back up. And then when we need them, we can drill them again. We already did it once. We did it 100 years ago. We know how to drill for oil. The strategic petroleum reserve doesn't have to be a tanker above ground. You can just go take an old well that you already had, that you already took a few hundred million barrels out of, and just fill it back up. And then you have to have just a rational energy policy that allows you to do that. And that would include pipelines too. I mean, I'm not against pipelines. I'm against pipelines the way they handle them now. You know, if you ever actually see an oil pipeline, it's more like a freaking PVC pipeline. It's like your toilet pipes. They have two kinds. They have the kinds that are like the plumbing in your house, and they have the kind that are like a very thin metal shell. And when they say pipeline, you think of like this big fancy thing or whatever. It's like the Holland Tunnel. It is not. It is just a pipe that goes a really, really long way. And there are better ways to handle it. There are better. I mean, obviously, just make it better in the first place. You know, make something that lasts and put sensors on it and have a warning the second there's any kind of leak. Have a sensor every 3 freaking feet that tells you if oil is leaking somewhere. Have drones patrol it, so on and so forth. There's definitely ways to do this. You know, you spend a little bit more money doing a better job so that we have a better pipeline, one that people don't object to. The objection of the pipeline is because they construct them as cheaply as possible, because they would rather have a leak. The pipeline company would rather have a leak than spend the money to make sure it can't leak. And nothing can't leak, but realistically, you could just do a better job of building it in the first place. We have sewer ducts that don't, you know, we have sewer pipelines that don't leak. We have water pipelines that don't leak. You know, we managed to like move water from place to place and so on and so forth. We could take sewer out of the city. You don't have a lot of major sewage spills and things like that. Natural gas, we got pipelines all over the place that don't leak. Just build it right. You know, and anyway, so meanwhile, the raising of the mileage standards for cars is going to cut pollution. Obviously, you're still using oil, but you're using much less per mile. And I'm hoping this carbon capture stuff works. My stepfather was a chemist, and he actually explained to me carbon capture like 20 years ago and was like, this is a good technology, you know, we should really start developing this. And at the time I was like, oh, okay. It sounded interesting. And now it's like, okay, let's save the planet with this. We have a screwed up policy. I mean, there's no other way around it. I mean, people have to pay what it really costs to use the gasoline. You know, and clearly $100 oil doesn't collapse our economy. Therefore, when oil goes back to 60, put a freaking $10 a barrel tax on it. That's all. And use that money, which is 10. Well, we're using 20 million barrels a day, right? So where'd it go? Okay, so we're using 20 million barrels a day times 365 days is 7 billion. So if we're using 10, we'd have $70 billion a year with a $10 per barrel tax on oil. We would be getting $73 billion a year that we can put towards getting ourselves off oil. So don't say it's too expensive. It's not too expensive. We're already paying it now. This is the cost of not being off oil. We're paying $100 a barrel. So when it goes back to 80, let it be 90. When it goes back to 60, let it be 70, whatever. It's because ultimately this is our future. You're going to be paying this kind of money. Obviously any disruption to the global supply of oil, and all of a sudden you're in the hundreds again. So how about we take it seriously and actually pay what it really costs to get ourselves off the oil and to clean up the mess the oil makes that we use. You know, and again, how complicated is that? Why can't Joe Biden get on TV with a couple of charts and say, hey, here's what we got to do? I don't know what, I mean, I don't know what happened to this country. I was just listening to one of, Roosevelt's fireside chats, right? Because World War II and the Depression also. And Roosevelt used to sit there on the radio, but he'd sit there on the radio and say, here's what's happening. and here's why we're doing this, and here's why we all need to do that, and blah, blah, blah. It's like, that's what you should do when you're the president. They don't really do that. It's, you know, Biden does a couple of press conferences and he just talked about, I don't remember, he was just talking about something this week. I forgot what it was. But I mean, there's so many things that we could fix by just saying, hey, here's what we got to do and fix it. Same thing with election laws. Okay, do you want to be in a democracy or do you not want to be in a democracy? If you want to be in a democracy, then everybody gets one vote. Let's make sure that's happening. But here's the thing, you can't make sure you get a vote and somebody else doesn't get a vote. That's not a democracy. Everybody has to be able to vote. Let's make sure everybody gets one vote and uses it. That's how a democracy works. So anyway, all right, so there's the oil, and this is, you know, again, this is, I think very shortable here, but, you know, you could get burned. That's the problem. You know, at any point, Putin can do something crazy and oil will go up to 115. So it's, you know, it's not something to really put a lot of money into, but I mean, in all things being the same, this is too expensive by far, no question about it. And boy, the dollar took a dive. That's why the market picked up. Look what happened. The dollar went from 150 to 99.80. So it's almost 1% down. And that's and the market's only 1% up. So I mean, that's pretty sad. Because you buy this stock with this dollar. So if the dollar goes down, you need more of them to buy the stock. It's not complicated. And the price of all stocks goes up when the dollar goes down, because that's what you buy. Just like gold, the dollar goes down, you need more dollars to buy gold. Therefore, gold goes up. Same thing with every stock. And that's also what's helping to punch oil back up. That's you can see gasoline taking a big hike over here and whatever. You always got to look at that also. You know, when things move suddenly, you want to always look at the dollar and see what the dollar's been doing. That's a really sharp drop. And I'm not sure what the reason is. Probably no reason, though, because it's actually not that hard to manipulate the dollar. So, you know, they do it a lot to set a tone. But speaking of which, so how many of these are there? I better leave it for now. But what was I going to say? Oh, we don't have it. Okay. brbriefing.com. Calendars economic. There you go. Log in. I'm not a robot. Calendars economic this week. All right. So what is today? Today's the 13th? Yeah. So yesterday we had the CPI. The CPI was completely out of control. And it's, you know, it was 1.2%. People were expecting 1.2, 1.3%, but that's not the point. The point is that when you have it up 1.2% for the month, you're on a pace of more than 12% for the year. I mean, it's 12, 14% for the year inflation. So, but the average, oh, I bet you can see it right here. Yeah, so the average has been 6, 8, and 1.2. So basically, that's okay. So 6 and 12 is 18 divided by 2 is 9, and then 9 and 8, and that's how you get to then 9 averages with 8, and you get to 8.5 points. So on an annualized pacing, we're at 8.5 points. All right, but it's going, but that's, sorry, let's look at it again. Okay, so you say that, but the point is, it was 6 and it went up 33% to 8, and then it went up 50% to 1.2. So what do you think? It's going to go negative all of a sudden? No, that's not how it works. Okay, you're not going to suddenly reverse. It doesn't happen that way. I mean, it could, if something significantly spiked up for no reason and went the other way and blah, 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 but it's just not going to happen to the broader price index. Oil's going to reverse, and we'll see what kind of effect that has. That's going to be the one thing that might save them, is hopefully oil prices come back down. But by the way, this war, it's not ending. This is a long-term war. Putin is showing no signs at all of taking peace negotiations seriously. He's racking up, he's racking up dead people in Ukraine. He's sending more and more troops in. He's bringing in more recruits from Russia to go, or whatever you call them, conscripts. So why would this war be winding down? Where they, a lot of these economists are like, oh yeah, everything will be fine. We'll go back to normal right after the war. It's like, what if the war keeps going? What if it gets bigger? Does anyone have any kind of plan for that at all? But anyway, so where does the consumer price index come from? It's food and beverages, housing, rent, apparel, transportation, motor fuel, medical care, education, specialty. It's the economy, basically, right? So if I want to look ahead to figure out where consumer prices are going, what do I look at? How about producer prices? Look at producer prices. So, these are record producer prices. So producer prices have gone from 1.2, 0.9, 1.4. This is a horrifying annual pace. It's like, more than 12%. Food and energy, no, forget food and energy. I'm sorry, core. Oh, there is no core, excluding. Why is there no core? That's weird. That's why I said food and energy. I read the category over. I was like, wait, it's supposed to be core. Anyhow, so producer prices went up 50% from February to March. But what is the progression of consumer prices? Obviously, first, there are producer prices, then the consumer has to buy the goods at the higher prices that the producer paid. And you know what else is there? Wholesale prices. And wholesale prices are at record highs. Is that on this thing? No. I'm done with you. Wholesale price index. That also came out, but nobody talked about it. News. Supply prices rose 11.2%, the biggest gain on record. So before the producer price, so in other words, the producer prices are in the middle, wholesale prices come first, right? Things come off the boat and they come in wholesale, and then they go to the producers, who then produce something and take the goods and commodities and all that and turn it into something that the consumer buys. So there's like a 3-month lag. Even if you think of a really efficient system, right? Something comes off the boat, it goes to the factory turns it out, it goes to the store. Let's say that all takes a month per cycle. But that means then that these extremely high wholesale prices haven't hit the producers yet, and the producer prices, the higher producer prices, haven't hit the consumers yet. So we've got at least 3 more months of higher CPI ahead of us. That's how these numbers come. And again, nobody understands these things. Everybody looks at these numbers like they appear magically. It's like from a burning bush, right? It's like the voice of God. Oh, your CPI is this. No, there's a freaking way to calculate it. That way is known. There's a way. There's a progression of where these prices come from. Something comes off the boat at a certain price, a commodity. You then take the commodity and you use it, turn it into a product, and then you take the product and you bring it to the retailers, and the retailers sell it. And everybody's got to at least try not to, everybody has to make a profit or at least not lose money in this chain. Otherwise, at some point, the whole thing breaks down. So therefore, it's effectively a scientific fact that if the wholesale prices are record highs, it hasn't been it hasn't hit the producers yet, because it's just happened now. And then if they haven't hit it yet, then it hasn't hit the consumers yet. It's got to take time for it to filter through. And that's why I was so pissed off this morning when I'm looking at this chart. And I'm like, how is it possible? How is it possible for these economists? It just pisses me off so much that these people get listened to. How is it possible that these people still think that that we're going to be going lower? There's no logical way that we're going lower in that amount of time. And especially like miraculously, it all goes back, and all of a sudden it's like, oh no, 2% inflation, of course. And that goes back to the next part. Oh, I'm sorry. There's another part of the cycle. So then this is how it becomes a big circle. So prices come off the boat. They go to the producers. The producers give it to the consumers. The consumers go to their bosses and say, hey, I can't freaking afford to live. I need a goddamn raise. Then you give the consumers a raise, and now the cost of making everything goes back up, and that's going to filter through. And that's why the Fed is more terrified of wage inflation than anything else, because once wage inflation is embedded, once consumers expect it, and again, I was I went to high school in the late 70s, exactly when there was a lot of inflation. So I started my working career in the second half of the 70s, and then in the 80s, I was in 81. I went to college. I was out of college in 85. You expected the entire time I worked, from the first real job I got until well into the end of the 80s, it was effectively expected that you would get a 10% raise every year. And if you didn't get a 10% and a bonus and Christmas bonuses, which have kind of gone by the wayside. And Christmas bonus is what? It's like 2 weeks salary usually. So Christmas bonus of 2 weeks salary is 2 out of 52 is what, 4%. So you get like a 4% bonus of your wages as a Christmas bonus, because with inflation, nobody could save any freaking money. That was a big deal. So that was where you got your money for Christmas shopping. Because you really couldn't keep up, because it was basically you get a raise at some point during the year, and as time went on during the year, you less and less and less were you able to get until you got your next raise. And that's what would happen. It would grind you down, and you'd eventually be at the point where you just go to your boss and be like, okay, dude, here's the situation. Either you pay me more money, or I have to quit and get a job that pays me more money. And it was the same kind of thing, though. There was a lot of jobs. Although we went through like a recession for a while where there probably weren't as many jobs. I never personally had a thing getting a job, but I haven't worked for anybody else since I would say like early 90s. I think the early 90s was the last time I had anybody I had to answer to. Other than clients, of course. So, you're talking to a guy who hasn't had a job. I haven't had a job in 30 years. But like I said, though, I quit several jobs because they just didn't give me enough raises and whatever. And really, good jobs, nothing about the job or anything else. I'm just like, dude, if you can't pay me, I've got to go work somewhere where they can pay me. I've managed people in the same situation, though. I've also had companies where I've employed people, and you gotta be realistic about what they need to have to keep working. You can't expect people to be, and I generally try to take good care of my workers, and the reason for that is, to me, is that if they're not worried about money, they can be a lot more productive. They're happier coming into work, they're more productive, and they like their job better, and you're more likely to retain them. And the cost of doing that, of paying them 10% more than you would otherwise, just to make sure that they're financially more comfortable, is completely worth it. You know, I mean, well, again, it depends what kind of a business you have, but you know, if you're in a business where labor is a third of your costs, and you pay your workers 10% more, even 20% more, what's that going to be? 6% of your total revenues? Believe me, you can raise your price to 6% when your customers get that kind of service. You know, happier workers who like their jobs and who stay, and that's another thing for the customers, because they always call, they talk to the same people, they work with the same people. No, but you're not shuffling new people in constantly and so on. You're not retraining people. There's so many ways it pays you back. You know, but the key is, I mean, and you all see it. You see people sitting in offices, and they're like calling, like, you know, they're calling banks, they're calling bill collectors, they're trying to negotiate with the babysitter for an extra hour and whatever. And it's like, because it's constant money worries, money, money, money. Because when you don't have it, it's all you can think about. And you can't do that to people. It's not fair to do that to people who work for you. It really isn't. Anyhow, so point being, once you get to this wage cycle, like we had in the 70s and 80s, and people will basically, a 10% raise is like a given every year for a job, then obviously prices are going to go up 10% every year. And it's very, very hard to break that. And we had the savings and loan crisis in 1987 that caused a recession. I think that's what really broke that cycle. And that was the savings, the 87 crisis was not too different than what happened in 2008. The banks, you know, lent too much money on stupid properties, and everybody was overpaying, and that was because of the Japanese were coming in and buying everything in sight because they had tons of money, and it all collapsed. And the banks got left holding the bag, which, as I said also today, is again happening, because here we are. We have, I mean, let's really consider this concept. $1,560 per foot in Cambridge, Massachusetts. That's where Harvard is. That's because that's our tech hub. That's like Cupertino kind of area. Well, look, I mean, all this area here is $800 a square foot. This is double that, because we don't have a big tech hub. They've got 3 places in California where tech companies like to go. Yeah, this is retail. That's a different problem. But here in Cambridge, that's basically the only place we have a tech hub in the East Coast. And people are just paying ridiculous amounts of money. And also, you know, Cambridge, Massachusetts is a very, very limited area. It doesn't have it's not like you can sprawl out from it. But just think about that conceptually. Think about $1,500 a foot. Even if you have a cubicle's got to be what, like 25 square feet, right? It's got to be 5 foot by 5 foot. So if it's 25 feet times 1,560, 39,000 a year to sit somebody down at a desk. That's not including paying them. That's what it costs you for the space that you put their desk in. And that's it. And that's not counting the common areas or anything else. That's just saying, boom, one person sitting at one desk is using $39,000 worth of resources. You'd probably have to add 30% to that to, you know, approximate what they're actually using with the commons and all that. So think about the economics of that. And when you're talking about retailers, the other thing, though, when you're in Beverly Hills, 1,200 foot, it's the same thing. You got a store, and your store's 1,000 feet, right? That's about a normal kind of store. So you have a store that's 1,000 feet times 1,277. That's $1.2 million a year just for the store, not including utilities and anything else you got to pay towards it, just to have that piece of store space is $1.2 million. So therefore, divided by 365, you have to make profit $3,500 a day just to pay for the store. So, and again, that blows my mind, because when you sit there and you've got that kind of nut, and then you tell your workers that you can't afford to pay them $15 an hour, I want to shoot these people. That is completely ridiculous, and also the thought process is out of whack. You should have $50 an hour employees, $100 an hour employees in a $4,000 a day store. That's not your problem. Your problem isn't your cost of employees. Your problem is your cost of rent. And then, of course, obviously, that's why when you're in Beverly Hills, they have to rip you off. There's no choice. They have to charge you a ridiculous amount of money. They have to charge you $400 for a tie. They have to charge you $800 for a pair of shoes. They can't make any money otherwise. They have to sell the most expensive shit you've ever seen. It all goes around. So, you got to pay people more, you got to charge more for your goods, the people want more because they have to pay more for the goods, so on and so forth. It's a horrifying cycle that's very hard to break, especially without causing a recession. And that's what they talk about, a soft landing. What a soft landing means is basically is normalizing rates without a recession. That's a soft landing. A hard landing is a recession. Again, people overcomplicate things. So meanwhile, you have these insanely expensive rates, and the vacancy rates of office space is shooting up, especially in central business districts. And when you talk about this, is something I should have mentioned here. When normally historic vacancies are 9.6%, right? That's suburban. That's a suburban number. Now, most rents are suburban rents, but the problem is what you have to look at is what's happening to the inner cities. And we talked about this before. What's happening in downtown? What's happening in these places where they're getting $800? Well, nobody's coming from here. Nobody's coming from the suburbs to go pay $800 a foot. Okay, and you can see that because there's a ridiculous amount of stores that have boarded up now in a lot of cities that just nobody's taking them. And these landlords in these central business districts, of course, they're charging these prices, but they're also paying this much for a building. They're paying all that incredible amount of money for the building that the thing is in, plus their taxes, utilities, so on and so forth. They can't afford to be 12% unoccupied. They are used to being 6% unoccupied or less. Basically, and again, because in the cities, generally everything's full, right? In New York City, it used to be a curiosity when there's an empty shop. You'd see an empty shop, and then you'd be like, oh, I wonder what's going to be here. And then 2 weeks later, it'd be like something else to be there because everybody wanted the space. And that's why you have 10-year leases. People sign 10-year leases, and that's the only reason things haven't collapsed yet, is because most retail space has 5 and 10-year leases, and this crisis has only been going on for 2 years. This drastic change that we're now experiencing, where suddenly, in fact, actually, what's interesting? Before this happened, before this crisis, there was already a lack of a utilization lack in the cities, but WeWork ran around and bought up a ton of property, and then they, as we know, they basically collapsed. But WeWork bought up so much building space that they became like the major tenant for like many cities. They were like the largest occupier of space. Because they had a speculative idea, blah, 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 that people use the space and so on and so forth. So then COVID hit, which destroyed WeWork. And So those, but WeWork's buildings were on long-term leases, of course. They took the space on long-term leases. I'm not sure how that's ending up being resolved for them. Then you've got, but then the crisis hit, and now all the regular places, they've had, they have 2-year leases. I'm sorry, they have 5-year leases, 10-year leases, and so we're 2 years into a crisis. Now, some people randomly have their leases coming up, and some don't. But the people who are coming up for renewals are basically now they're choking and saying, we don't want this much space again. Now, for landlords, that's really tough, though, because, you kind of leased out a whole floor to a company, and now the company's saying, you know what, we only want half a floor. So first of all, it's less attractive to have half a floor and to bring in another company when you've already leased out half the floor. And also the difficulty in finding it when there's so much empty space around. Now, the landlord has a building. The building has a value. This is another thing that's going on because we were bailing out the landlords, right? And in many ways, we bailed out the landlords, and which of course then bails out the banks because everything we do is for the banks ultimately in this country. But last year or 2 years ago, we were sending out checks to pay, so companies could pay their rent and pay the payroll of people who weren't showing up for work. So even though in theory in a normal economy, if they had an empty office and nobody was there and the company was effectively making no money, they would go bankrupt and close, and the space would close and go back on the market and so on and so forth. But what happened is we kept the rates elevated. We kept the rents elevated. So the rents never got cheaper because we bailed everybody out. Also, the stuff didn't go on the market that should have gone on the market. So there's never been a repricing. And so now we're 2 years into this slump and this huge downturn, and all this space is coming up on the market at the same time because of all the extensions and so on and so forth that happened. So with all this space coming up for renewal and people don't want it, it floods the market with extra space, but the landlords won't lower their prices because if they lower their prices, then the calculation for the person who wants to buy the building changes. And that's how you get into a crisis. This is what happened in 2007, 2008. Because the real estate market kind of started collapsing in 2006, but the landlords, they would not normalize their rents. So what would happen is they would just keep charging the same rent and let the building be emptier and emptier. But then it gets to a certain point where you've got your occupancy rate declines to a point where you now have to sell the building, but now you have to sell the building, and there's a certain a buyer is going to accept the fact that 5%, 10% of the building is empty. They'll be like, oh, okay, that's fine. It's normal turnover, whatever. But when you get into 15, 20% of your building is empty, now they're like, oh, no, this building has no demand. Therefore, you claim that these properties are rentable at X amount based on your current tenant base. But in reality, you have clearly not been able to fill your additional spaces at those prices. There's a certain point at which the buyers start wising up and which the banks start recalculating how much they'll lend. Their loan to value ratios start changing. And that's what and that's why you see so many empty spaces that stay on the market for so long, because for the landlord to take the second the landlord takes a lower rent, he's devaluing his building. So in other words, if I'm renting, if I'm renting to a restaurant downstairs at $5,000 a month for the restaurant, right? And that restaurant then leaves. Now, when I'm going to do first of all, of course, you have the long-term rent, so you tend to get paid even after they leave, unless they go completely bankrupt. But you've got I've got my space at $5,000 a month downstairs. Based on that space, and obviously other spaces, I'm just making it simple, but based on that space, that I get $60,000 a year from the restaurant in the ground floor of my building, and maybe I get whatever, maybe my total rent base. So maybe my building's worth $2 million, $3 million, whatever it is, right? But if I drop the rent to $4,000, all of a sudden my building goes from $2 million to $21.6 million. So for me to take $1,000 less per month for the space, I'm going to lose $400,000 of my building's value. So I'm not going to do that unless I really, really have to. And now you say, okay, well, $5,000 a month, it's $60,000 a year. But you know what? $60,000 is not $400,000. So many landlords make this calculation, and they will say to themselves, I would rather lose $60,000 and keep trying to sell my building or keep the value of my building. Because the minute I capitulate and give somebody a $4,000 rent in a 5-year contract, I have now totally devalued my building. And there's no recovery from that unless I ride out this rent and then write a higher rent for the next guy. So the landlord is going to capitulate and devalue his building for 5 years, 10 years, depending on what kind of terms the guy wants who's coming in. So when you see these empty spaces and you wonder what the frick, it's because, I don't want to say can't, but the landlord in their own math, they can't lower the rent spaces to make it palatable for a new person to come in. And that's all this shit is really interconnected and very complicated in the economy. And that's the reason that when you can walk downtown and you can see 1 out of 4 stores are empty, because we're not deep enough into the crisis. Since everybody got bailed out for the last 2 years, we're not deep enough into the crisis where the landlords have capitulated and have lowered the rents. And if the landlords aren't capitulating, they're just going to leave those stores empty at ridiculous rents that nobody can pay. Now, when you have a proper correction and the rents do come down 20%, 30%, whatever, all of a sudden now, instead of this person having what do we say it was, $2 million, whatever the hell the number is. So instead of 1,277 times, so $1.2 million, obviously. So instead of a person with a 1,000-foot store having to pay $1.2 million, let's say now they only have to pay $800,000. So it goes from $1,200 to $800 a foot. So if you have a correction like that, all of a sudden now that store becomes almost palatable to people selling more reasonably priced goods. So what happens in the economy? A person comes in, they get a better rent, and they are able to sell goods and services at a more reasonable price and make their money, and so on and so forth. And who loses? The landlord. He's going to lose because now his building, if he tries to sell it, is only X. But that's what happens in a recession. But that's why in 2007 and 2008, you saw this snap, because once the banks started getting hit with loan-to-value ratios that weren't working out, where the banks would end up getting possession of a building, and then they turn around to sell it and find out nobody's going to pay these rents, and nobody's going to buy these buildings at these prices because they're empty. So once the banks start doing that, they start repricing the LTV ratios, and they start telling their landlords, well, you can't do this and you can't do that. All of a sudden, the landlord can't sell the building no matter what, because nobody can get a loan based on the price he's asking for his building. That's the ultimate break on prices, is when the banks refuse to lend the money for it. There are some cash buyers, but not too many cash buyers. And in fact, that's what went wrong with Japan, because the Japanese were coming in, buying buildings in major cities, and they had no clue of the prices, and they didn't do them. Their math was completely different than ours, and they bought stuff that never should have been bought for prices that never should have been paid. Anyway, so that's why things snap down, because all of a sudden the banks start saying, okay, we're not going to do this anymore, and then all of a sudden everything collapses. And the real estate market in a lot of places dropped like 50% in 2008, 2009. But it's almost healthy when that happens, though, because then you can do things, and then a new restaurant can come in and move into a space and be able to make some money, instead of like everything is for the rent. You want the restaurant to be able to put money into the food. You want the restaurant to be able to hire a good chef, and have good waiters and pay and have nice silverware and so on and so forth. All that is based, there's a certain cost. If all the money gets sucked into rent, everything else starts suffering. And I bet you guys see that a lot, right? I notice it. I'm a foodie. So for me, it's like it so pisses me off when a restaurant, they don't want to raise prices, so instead they start, getting cheaper cuts of meat and getting lesser ingredients and so on and so forth, and you can tell the quality starts slipping. The portions aren't as good. I even noticed that with in fact, I was having some meatballs the other day, and the guy's using more bread in his meatballs. And I'm like, this is bullshit. If I wanted bread, I would order bread. It's like, freaking don't stuff your meatballs with bread and say it's the same thing. But anyways, it's all these little ways they get you, portion sizes shrink and so on and so forth. So these are all rolling, but so anyway, the short story is these are all rolling problems that are getting worse, not better, and they're not going to magically go away. They're not, okay? It's not, it's never going to magically be okay for people to pay this kind of money. Prices have to correct, and until they correct, this won't really be over. And we could be years away from a real correction. See if anybody has any questions. Nobody has any questions. Andrew says, Phil for Congress. Thank you, Andrew. Congress, though, Senate. I'm sorry, I cannot accept anything lower than Senate. Because I'd be embarrassed to be a congressman. Oh my God. I mean, they have no power, and they're a bunch of morons, and all they do is run for election. That's all they do. Because you got a 2-year cycle. Again, very stupid system, right? You have a 2-year cycle, which means as soon as they're elected, as soon as they're in office, first of all, they're elected in November, right? Then they take office January 1st. So that's already 3 months after they've been elected. And now they're 1 year away from the next election cycle. So how much time do they have to do anything other than, than try to get a few sound bites that they can use for the next election cycle? And that's why you see them standing up and trying to make the most outrageous claims and say the craziest things and whatever. They just want to get a camera on them. They just want someone to take their picture and write an article about them. And if they have an article, they can take out 3 or 4 words that are good, that sound good. And that's how that works. So at least in the Senate, you got 6 years, so you can actually spend a few years doing your job. But I will tell you though, I thought about this. If I would run for the Senate, and I'd probably be murdered. But my idea is to run for the Senate and promise my people that I will wear a GoPro camera at all times, and I will have a feed of every single thing that goes on in that frickin' Senate. And I will have every goddamn thing taped, and I'll put it on the website every single day, and you will see how this really works, because people need to see how this shit really works, because it's a frickin' embarrassment. But now the problem with that is, of course, everybody will know I have a camera, therefore everybody's gonna, a lot of shit won't happen in front of me. Everybody will be like, oh, Phil's coming, hard. Everybody hide, Phil's coming. But I just think something like that needs to be done. It really does, because this is it's out of control. We have what they call a kleptocracy. It's effectively a government run by criminals, and it's just as bad as any corrupt government you've ever seen. That what's his face, Manchin, the freaking supposed Democrat, who he's nothing more than a Trojan horse who has been put in by the oil companies and the coal companies to fuck up the Democrats. That's all he is. To call this guy a Democrat is ridiculous, and all he ever does is block everything that's supposed to be done. And you can't get rid of him. You can't get rid of these senators. It's crazy. Which is why I want that job. I mean, it's no matter what kind of shit I pull, they can't get rid of me. But it's scary. It really is. Anyway, so there's that. Take a look at, we did the short-term portfolio review. We've got, I forget the number, I think it's $1.7 million worth of hedges in this portfolio. So we feel very good about that. Notice that we have the short puts, because if things go well and the short puts expire worthless, it's 50, 60 something, $65,000 almost worth of long. So in other words, if things go up, we get paid off over there. Not that that's really going to help, but just to offset some of the if it goes against us. But this is insurance money. We spent this money. We spent $364,000 on these positions, and they're insurance, and we will fully expect to lose $364,000 if the market doesn't go down over the next 2 years. But that's okay, because the long-term portfolio is going to crush it. And that's what the hedges are for. The hedges allow us to ride out the long-term positions. So long-term positions are now almost 2.5 million. We have 1.7 million in cash, so that's nice. We only have net 700,000 securities, but that's because, of course, we sell a lot of puts. And like I said, if we really think the market starts breaking down, and it almost did. I mean, we were last week, we were getting pretty red on all the indicators. If the market starts to seriously break down, we have to pull these puts. And let's see, we have, I'm going to ignore a lot of it. 10, cancel. See, that cancels that. So it was 10. Now we get to 5, 6, 9, minus 20 is negative 10, minus negative 15. But then this is back to negative 10, and call that negative 5, 0. Now we're back to 0. Now we're plus 3, minus 3. So that's back to 0 again, minus 10. Cancel. Minus 10 plus 2 is minus 8. Minus 10 again, minus 25. So we're $25,000 down on the short puts. That was an extremely rough estimate, but So if we say we're minus $25,000 on the short puts, that's all it cost us to pull the plug on the whole thing. So minus $50,000, even minus $100,000, we're not going to pull it. But when we're minus $100,000, and I'd rather pull it there, because I think I said that last week. You can always sell more puts. And in fact, frankly, this guy needs to go, the Halliburton short put. Not that it's in any danger of triggering, but it's all the way to January, and all we can do is make $1,000 more between now and January. And if we pull that off, we get the cash. Well, there's no cash. I'm sorry. If we pull that off, we release some margin, and we can sell something else that's going to be more productive for us. But that's the only one that's really that far in the money. And I'll be doing long-term portfolio review shortly. We did the short-term portfolio, I did the butterfly portfolio yesterday, and the money talk portfolio yesterday. So those are 3 portfolios we did yesterday. And so now I got the long-term, the income portfolio, and the dividend portfolio left. And we only have tomorrow, because tomorrow is expiration day. The Friday the markets are closed. Anyway, so we got Chimera is good. Apollo is good. Boeing we just took. Oh, look at that. Negative? Really? See, this is just an options trick, because we just took this yesterday. Oh, I see. No, because we were already down. We took these guys a long time ago. These puts we took a long time ago. And they're minus 5. This spread that we just took yesterday that we added is up 3,000. That makes more sense, because Boeing's up $6 today. Very nice. It's funny, because we talked about this yesterday. Oh, this is an important point. Let's make this point. People don't know how to read data. They don't understand. They don't understand what a news story means. And that's the kind of stuff we look for to invest, but it's really weird. You can't search for BA because there's too many things. Come on, when do we do this? See, on every instance of. There we go. Hey, all right. So yesterday at some point in the day at 2 o'clock. Okay, right. And it was a top trade. I could have just looked at the top trade. Haha. All right. So the headline, Boeing delivered 95 commercial planes in Q1. But everything like that is meaningless unless you know the context. Okay, so up from 77 a year ago. Okay, that's some context. But what do I really want to know? I want to know what they make on 95 planes. Okay, so I went and looked that up. I went and figured out, not exactly, but I went and looked and said, well, last time they had this kind of revenue. So I looked at Q1, that's a definite number, and I added 20% to that, just assume that they're making 20% more money. And then I said, well, that's kind of what Q2 was for them. So Q2, so basically you say, look at Q2, and in Q2 they made $2.5 billion. So then therefore, if Q1 is $2.5 billion already, even if Q2 doesn't get better, they're on pace to make $10 billion. So that's nice. But the headline in many, many places was this: Boeing dropped 152 aircraft from its backlog for accounting requirements in March. Now, I didn't need to look that up. I already know that Boeing has a 4,000 or 5,000 plane backlog. So who the hell cares if they scratch 152 off their backlog because they've been promised to Russian oligarchs or whatever the problem is? But nothing, it's a meaningless number. But that's the problem. People will read the headline. There were headlines both ways. You saw headlines talking about Boeing doing great, and you saw headlines about Boeing canceling orders. And the headlines of Boeing canceling orders causes people to sell. And it certainly causes the algos to sell, because that's what they look for. They look for, if bad news, then to reduce position by X. That's something that was programmed into them a year ago. It has nothing to do with what really happened. That's the problem. These computers read headlines, react to headlines. They don't understand the headlines. They don't dig deeper. And that's why if you dig deeper, you have a huge advantage in the market, because most of the people you're trading against are actually robots. And of course, most of the humans you're trading against aren't that smart. That's the other thing you need to know. So, 95 aircraft delivered, 868 were 737s. Wow, that's impressive. 868 out of 95. I assume they mean 86. I don't know. Who knows what they mean? But here, oh, by the way, here's the other thing though when you read this. So 95 deliveries in Q1, 41 were in March. Now, March is when the war started. March is when the supply chain was different than it was in January and February. So when I see 41, so in other words, we have a quarter that was 20% better than last year, but the last month of the quarter was significantly above the first 2 months, obviously, since it's 41, which is almost half of the total for the quarter. So therefore, we have Boeing clearly accelerating their completions of planes. They're doing very well, better, much, much better than anticipated, and it's getting better, not worse. Oh, and that's where you get to 86. It's 41, so 3/4 of their planes are the Maxes, so therefore that number makes sense if it's 86. Blah, 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 and they've got the results out. And so yesterday I said Q1 last year, they made 1.4 billion on 15 billion in sales. Q2, they made 2.4 billion on 1.7 billion in sales, 23% more than 14 billion to 17 billion. So we can infer profit should be more like Q2, and Boeing is only expected to make 2 billion. They're only expected to make 2 billion all year by analysts. They're going to blow right through these numbers. I said it's possible materials and labor are hitting them on cost, but 41 in March is a huge improvement, and they'll find the right price. And I'm sure in their contracts, it's not Boeing's first time in the market, right? So in their contracts, they've got allowances for all these cost increases and everything else. Because don't forget, you're selling a guy a plane 10 years before he's actually going to get the delivery of the plane. So you can bet that you're not selling a guy a plane for a certain amount of money. He's buying the right to buy a plane. And when you make the plane, you'll tell him how much it costs. That's how Boeing works. People don't understand that either. You know, they're not sticking to the price of 10 years ago for the plane. So I said we already sold 5 of the puts, and we're down 45%, but we don't not worried about that. We can roll it or do whatever. So I said I don't see the need to sell. I don't want to sell more puts unless they go significantly lower, but that may never happen because this is I think way underestimated. Blah 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 blah. And I was talking about what we can do at 4 rows. So I said, so I'm very sure I want to buy 1,000 shares of Boeing for $135 now. So in other words, we'd have $135,000 worth of Boeing. And I was talking about if you do it as a new play, that I would sell the what was I saying? I don't know. We sell 5 200 puts. What was I talking about here? The 150 puts a 19. Oh, I see. So so if we roll, so now roll for net 135. Okay. So what I'm saying is that we already sold these puts. If we have to double down on them, we'll end up having 10 short at a net 135. And I know for sure I want to buy $135,000 worth of Boeing, and that's only going to trigger if we have to roll and double down. Our worst case is that we'll end up having $135,000 worth of Boeing stock at 135, and keep in mind that it is actually at 182 right now. So would I want to buy it at 135? Yeah, I want to buy it now, and even if something bad happens, I still want to buy it for 135. And if we go back to March, it bottomed out at 100, but you know, you can't take that seriously because look how fast it bounced. It bounced right back. I mean, that's not really, that's telling you that 100 is the wrong price, and that basically 125 is a bottom that can be very easily sustained, and 150 seems to be pretty sustainable too. So easy to make that decision. So I say, so that, that's our worst case if we roll. So then I say, I consider our original $15,000 that we collected on 5 short puts originally to be free money, and we're going to now take that money and put it towards the spread. All right, and what do I mean by that? I mean this. Oh well, it's not there anymore. These 5 that we sold for $15,000 back in November. Okay, even though they're negative now, I'm like, I don't give a shit because I'll roll out of trouble on these. So therefore, this $15,000 to me is free money to credit towards the spread. Then we take the spread for $40,000 minus 15 is 25,000 total dollars on a spread that is 20 times 55, which is $110,000. It's $110,000 spread, $25,000 is our net entry. How could you not be thrilled with that? It's fantastic. All right, I hope I didn't do it too fast, but if I did, you can ask. But I mean, that's it. That's how we make a trade decision. That's like, just go through the thing, and where was it? What did I just do? There it is. So $28,000 is the net after the short puts, and that's it. We have 82,300% upside potential, and all Boeing has to do is get to 225. This is 225 right here. I'm not saying it's going to get back to 3 or 4 or any other thing. 225. A nice conservative spread that can make 300% in 2 years, not even 2 years. I mean, this is how you trade. But again, it goes back to people were actually selling this yesterday. This was red yesterday, a big red. Because of what? Because of this article? People don't know how to read. But and again, like I said, it's context. because you have these algorithms that react to headlines, and they read, this is exactly what they do though. They go through this and they say positive, negative, positive, negative, positive, negative, but there's no context to it. They don't know what the backlog is. They see canceled aircraft. That's a bad thing. They start selling it off. They see other, they see it just makes no sense. It's honestly, it's hard to even explain. It's hard to even explain why they would be selling, but it's just like they react to things without having the proper context in which to react. But you know what? So do most humans. They do the same thing because they're lazy. They read something and they click on it and they just don't, and they don't evaluate what they're actually doing. I think most people don't even read it though, frankly. Oh, they found the Brooklyn guy. Good. Ugh. That's terrible. All the pictures were horrible. Jamie Dimon says powerful forces threaten the economy. Okay. BlackRock did get 20% profit increase. Yeah, and meanwhile, that's another one though. JP Morgan, they took a hit on Russia. So this earnings drop includes that they already wrote off these Russian assets, and they took $1 billion as a loan loss reserve. So they basically tanked their own quarter. And that I'm sure is still selling off. Where is it? Chart, yeah. So people are selling them off. I'm not jumping in yet. I want to see where they settle down, but and there's other potential bad news coming to the bank, so I want to give it a little bit to see if they find the bottom. But I like JP Morgan. I've always liked JP Morgan, and they will muddle through. Don't worry. Don't worry about them. And how's Goldman Sachs looking? Now I see everybody's selling off a bit. Citibank. I mean that's a better buy most likely. Oh, how's TD? We always like TD if that. Nope. See, TD's not cheap enough. TD Bank's the best bank. All right. Anyway, Boeing. Here's Alibaba. Can't get out of there. They're below 100 now. I don't know. Munger got out. First, Munger got in, and now he got out. Really pissed me off. He was buying and buying and buying, and all of a sudden he bails out. So he took a big loss. And he must be worried about something, but I just think he took too big of a position. He was didn't want to have that on his tombstone. Here's Big Lots. Gonna have to start with, like I said, we're gonna have to start looking at people's debt levels. That's gonna be a big project, but we gotta start looking at everybody's debt levels and see how much it's gonna affect them. Talked about that last week. Boyd Gaming, Cheesecake, I like them. Cleveland Cliffs is incredible. We like them. Delta is a good airline. Dell we just added, right? So yeah, we just added Dell, and they're already taking a hit. Dow's fine in this environment. eBay we just added, also taking a hit. Facebook or Meta or whatever the hell they want to call themselves. They're gonna be interesting. We'll see what happens with them. Gilead, way too cheap. Gold, obviously we like gold. Oh, nice. Look at that. Oh, because they're over 25 now. Hanes brand, why would you not want that? Hewlett Packard, through the roof already, so we're miles over our goal. IBM, stock of the year again because we like it so much. Intel, runner-up stock of the year. So Intel's doing exactly what we thought it would do. It's having a very slow, lazy year, but we don't really care. We bought it for 2024. That's why it didn't make stock of the year, is because there were a lot of headwinds this year, but then it should clear up by the end of the year. Kraft Heinz still buying ketchup. The biotech ETF, horrendous performance. Mostly the put, though. It's mostly the put that's hurting us right now. So again, we will roll and we will adjust. These are only 2023 puts. I still think it's going to come back in 2023. I don't know if it's going to go up 100% from where it is now, but I'm not actually worried about that one. Lockheed Martin stock of the is it the century? No. Hang on. Lockheed Martin stock of the century. SunPower is that stock of the decade. So SunPower has a more immediate catalyst, but Lockheed Martin, with the space exploration coming up over the next 80 years, that space is going to become a huge industry. Of course, Lockheed Martin is going to dominate in that field, and then you've got nuclear fusion, which they are a top contender for, and nuclear fusion is going to be a $1 trillion business. So I like them. Logitech, not doing well, but I like them. Philip Morris, they're through the roof, so they're already in the money for us. Moderna, just ask Farm Boy. Farm Boy's not too thrilled with them. I like them too much. I really do. We're in trouble on the puts. See, it's not the calls, it's the puts. So we're in trouble on the puts. But again, so we're just going to take these 15 puts and we're going to roll them. And if we end up owning Moderna for the very long term, that's fine with me. Here's Mittal Steel. These are pretty new addition for us, and they're doing flat so far. Micron, very good chip maker, but they're, you know what? Actually, it's funny because it says we're not making any money, but the reality is it's a 60-80 spread. It's at $72, so it's $24,000 in the money. Right now, it's $24,000 in the money. The 60 puts are way out of the money. All right, so if it goes flat from here, it's $24,000, but you can buy the spread for $46,500 minus $28,950 minus $5,275 for $12,000. So even though the spread is $24,000 in the money, the cost of the spread is $12,275. And if we get to our goal at 80, it's going to be a $80,000 spread. No, is that right? No, 20. This is $20. I'm sorry, it's going to be a $40,000 spread. So it's currently $24,000. It can go to $40,000, and you can buy it for $12,000 now. I mean, the options are just crazy. It's just incredible how much money they just let you make. Speaking of pipelines, we were talking about pipelines earlier. Here's the Plains pipeline. Paramount used to be Viacom. We love them, and they finally started taking off on us, so huge money made there. Pfizer, how can you possibly not like Pfizer? Although they're not doing good, are they? Look at that, they fell back. How much did they fall back? Pissing me off. No, that's weird. They didn't fall back much. What do we have? We have naked 50 calls, and they're currently down. Wow, that's crazy. All right. PHM Home Builder not doing well, really. Might have to. That's one. See, there's one I might cut because it's not so sure how good they're going to do. QSR, I like the restaurants there. Rio Tinto or commodities. How could you possibly miss on that one? They blew over our targets. Tanger Factory Outlet. I always say family. Also, Miles in the money. How are they looking though? Ooh, lovely. We were just talking about them last week, right? It's saying they should pop because it's like they're stupidly low. SunPower, stock of the decade, certainly not worried about them. How are they? Oh, let's see how they're doing though. They seem to be improving a little bit. No, not even that exciting yet. This is going to get, the SunPower can get real exciting. you know, if it wasn't for the war, we'd be focusing on alternate energies and things like that. SWK is brand new, and that one's already doing okay. AT&T, this is incorrect because it's pricing in the options incorrectly. We didn't account for the split. But either way, it's fine though. It's not terrible. Well, it's down 50,000, but not terrible. TD, like I said, best bank, love them. Tupperware, still a thing. Just used it last night. Vale, another minerals, and also hugely in the money for us. VTOL, vertical takeoff and landing, or whatever the hell you call it. That's flying cars. We're gonna put on that one. Wheaton Precious Metals, I didn't understand why they wouldn't be much higher, and they already, but they, you know, they already threw our goal. And then see, this is another one because it's like the premiums are so insane that you feel like you're not doing good, but you are. It's 82,000 minus 62,750 minus 4400, so $14,850. And it's a $35,000 spread that's completely in the money. So a $35,000 spread that is in the money by $4, $4.50, 10% in the money, and you can get it for $14,850. The options are crazy. It's like if you get used to them, they're like the greatest thing on earth. And this one's obviously doing well too. Same thing. See, it's funny how we have, it's a good sign. If we have two different trades of the same thing, that means that we probably really like it. US Steel, of course, who doesn't want steel? That's another infrastructure play, and they're miles in the money. And then Yeti, not doing good so far, but not, you know, actually we rolled them, so to be fair, it's actually probably not doing well overall. But again, Yeti is one where we don't mind them owning them long term. It's sad they're not performing, but I think they'll do much better. Yeah. So those are our long-term positions. We did just roll these guys, so I'm not looking to do anything else, I don't think. You see, the thing about you don't buy back the $80 call because it's, you know, $80 is still a fair target. We didn't, you know, our upside doesn't go high. This is the tricky part about it. We don't have a higher upside just because we went down. So buying back the $80 calls doesn't really make sense. It's still our target. You know, and frankly, we think this is just a mistake. So we did roll down yesterday, not yesterday, last week or last month, and we rolled down to the 50s. I think we had the 60-80 spread, and now we have the 50-80 spread, and we added 10 more, and we added 10 more while we did it. So we took a bigger position of a lower strike, and we're already down $10,000 on that from what the movement is. But this can all turn around very, very nicely because if it all works out well, it's a $90,000 spread, and currently it's being valued at 52.5 minus 13.8 minus 209.00 minus 27.900. So it's a $10,100 credit on, I forgot what the spread was, 50-80 times a $90,000 spread. So you can make $100,000 if it hits 80 from 50. And we're not fully covered, and we're going to be able to sell puts. We'll be able to sell puts. We're going to be able to sell short calls along the way. But once we get over 70, everything is hunky dory. Over 70, this is already $60,000, right? 30 times 20. So this is $60,000 at 70, and both of these expire worthless. So, and we're at 56. So we need this thing to go up to 70 by 2024. And currently 70's right there. So that's our goal. And we're going to make, and that's a plus $70,000 for that position at 70. So of course I still like it. Why wouldn't I still like it? I think this is, the pricing's ridiculous. I don't see, there hasn't been any downturns or any downgrades or anything like that to them. just out of favor. Retail's out of favor. And that's the other thing. Always look at the competitors are hard here, but look at the ETF. They're just doing what the ETF is doing. The retail sector is out of favor. That's no reason to get out of a stock. You know, stocks go through periods where nobody likes them. And then they underperform and the chart looks ugly, and then all the TA people don't like them, and that's the end of it. Then once the TA people throw in the towel, it's really hard. You need a good, strong catalyst to get going again. That's what Intel's problem is right now. Intel has a very crappy chart. And so without an upside catalyst, they're not going to be able to punch back up. They don't have any upside catalysts coming in the near future. That's why in November, we decided they would not be the stock of the year, even though for many, many reasons, I do love them. I think they're very undervalued here. But it's not enough just to be undervalued. You have to be undervalued, and then something has to change. Certainly, the technicals aren't going to change unless people start buying. And if people and why are people going to start buying? There's no reason right now. You've got a supply chain shortage, so it doesn't matter if Intel can sell chips to IBM, Hewlett Packard, and Dell, because if one of the other 100 components of the IBM, Hewlett Packard, or Dell can't be delivered, then they can't use the Intel chip. They need to sell the whole computer, not just the part with the Intel chip on it, not just the motherboard. So you have to think about that. How does your company make money? Or how do they not make money? And that's where the bottleneck is for Intel right now. Until that starts getting resolved, Intel sales are going to be slow, and there's no real good way out of it. Okay, that's what they make. They make an essential, critical, important, and profitable part, but unfortunately, it's just a part. It's one of 100 pieces of a PC. You know, and you'll have the same problem with Corning, with GLW. You know, with screens, TVs, monitors, so on and so forth. They provide the glass for all these electronic devices, but if the electronic devices can't be delivered due to chip shortages or whatever, has nothing to do with them, doesn't impact their business at all. Or I'm sorry, it does impact their business, but it's got nothing to do with the way they're running their business. It's got nothing to do with consumer demand. It's got nothing to do with a trend that went against them. It's simply the macroeconomic situation is impacting them. But that's what makes them a great bargain. That's what you say when you're if you can be a 10-year long-term investor, these are your chances. And again, they're not low enough now for me to jump in, but these are your chances to get in and do this sort of thing. But you've got to look at the big picture of these things. And again, like in the earnings season, we love to grab these things like whoever I was just talking about before that sold off. Boeing. So like Boeing or like JP Morgan, it's like that's what earnings season is for. You've got to read the report better than the other people. And if you can look at these reports and think about how they really came about and what the real effects were and what the real long-term impact is, that's when we can get the bargains. All right, and we have a specific portfolio for the earnings portfolio where we specifically look for that stuff. But I think the problem with the earnings portfolio is it's kind of full. It's doing great. Oh no, we had 200,000 cash. Okay, I take that back. That may not be. Oh, those are zeros because of the they expired. That was short call. Okay, that probably is correct. That has to get fixed anyway. That hasn't been fixed yet. But anyway, that's probably about right for the earnings portfolio. So no, I'm sorry, we have plenty of cash, and that is exactly what we will be looking for. And frankly, well, Boeing wasn't. That's the thing. Boeing was not an earnings thing. It really is for earnings situations. So JP Morgan will qualify for this portfolio, Boeing did not, because it wasn't a reaction to earnings, it was a reaction to a news release that people don't know how to read a news release. All right, so that's where we are. JC says, your thoughts on PayPal? I'm not a PayPal fan. I've never been a PayPal fan. I don't think what they do is all that special. I just know they've always been overpriced. It's not my kind of stock. What are your plans for the WBD shares we acquired from the T-Spend? Oh, there you go. Well, first of all, I have to book them. So when we book them into the long-term portfolio, I'll try to figure out what we want to do with them, basically. I still have to figure out the rule, though, because we don't have this. Well, I'm sorry, we do have shares, because we have in one of the portfolios, I know we have shares. Like probably the dividend portfolio, we have shares of AT&T. But what are the plans? I don't know. Honestly, I haven't really put a lot of thought into it yet. I don't know how the company runs as a standalone. I don't know how much debt they took on. I don't know how much cash they've got. It's all got to be looked at. So that's, usually I say wait a quarter or two. I think this thing does have potential. It could do well by itself. So probably no reason to sell it. We'll probably just hold on to it and see what happens. So we'll work on that when I get the butterfly portfolio. All right, guys. So that's it for today. And we'll do the full review of the long-term portfolio tomorrow, as well as the earnings portfolio and the dividend portfolio. And the other ones we already did, so we're good. All right, thanks everybody for coming, and we'll do it again next week.